Hello, everyone, and thank you for attending today's webinar, The Path to Clarity, Overcoming Fragmented Data. We are so grateful you took your valuable time to listen to this discussion. This session will be recorded and will be available for on-demand viewing starting tomorrow. Now, before we begin, we need to cover just a few housekeeping items. If you have a moment, please do respond to the survey questions to the right of the presentation. That helps us so much to make these sessions more valuable for you. Also, at the bottom of your screen are multiple application engagement tools that you can use. All of these tools are resizable and movable, so definitely feel free to move them around to get the most out of your desktop space. Now, if you're looking for additional resources on this topic, you can also see the links below in the related content section. Now, if you have any questions during this session, you can submit them through the Q&A engagement tool. We will try to answer these questions during our session, but if a fuller answer is needed or we run out of time, we will attempt to answer them later via email. Please know that we do capture all questions. Now, for those looking to receive CPE credit today, please note we will be asking you to answer 4 multiple choice questions during today's event. Receiving your CPE credit is dependent on submitting an answer for at least 3 of these questions. It is also dependent on attending for the full duration of our session today. Now, if you're watching as a group, we love the enthusiasm, but you will need to log in individually if you want to receive CPE credit. These CPE questions will pop up in the middle of your screen, and there will be a limited amount of time for the answer to be submitted, so please make sure you're ready to answer when the question appears. And also, just note, you don't want to make your media player full screen, as this will cause you to miss the pop-up questions. Now, once you have met the CPE requirements, your certificate will be available for download in the CPE certificate engagement tool on your screen and in a post-event email, which will be sent about 1 hour after the event. Unfortunately, we are unable to provide CPE credit to those who have technology issues that prevent them from qualifying or for those who miss the polling questions. Now, we are delighted to welcome a stellar panel here and for what I think is going to be a fantastic discussion. We are delighted to welcome Nadia Picard, a partner in PwC Germany and the global reporting leader at PwC. Nadia, do you mind taking just a quick moment and introducing yourself for our audience?
Yeah, thank you, Steve. And maybe to keep it short, right? Find me on LinkedIn. You see what I'm about and what I comment on, and you see all the history. I am a German national living in Germany, having a global role at PwC, where I look after the future of corporate reporting, but really, to me, corporate reporting never works without the management reporting side of it. So I think that is a lot of what we will be covering today. And corporate reporting is so much more than financial reporting these days. So that is my interest. That is what I try to bring to life and develop a perspective on, and actually also make sure that we at PwC are prepared as best as we can to help you guys getting on with these tasks, really.
Well, if they do look in LinkedIn or look at any podcast, they will find plenty of content and material out there. Nadia, we are, again, delighted to have you. Looking forward to the discussion. And also, last but certainly not least, we are delighted to welcome Jake Weiss, the Director of Digital Finance Lead at PwC. Jake, again, we're so happy you're here. Do you mind taking a moment and introducing yourself?
Absolutely, Steve, and it's such a pleasure to be here, and thank you everyone for watching. So Jake Weiss and similar, we'll try and keep it quick. So I sit within our finance transformation, finance solutions practice. We like to change up the names, and within that I have always focused on digital finance, how digital technologies and digital transformation is going to impact the finance and accounting function, and that has manifested across reporting and analytics, automation, and most recently, a lot of emphasis and effort around AI. And of course, a through line in all of those areas, and in particular AI, as we will talk about today, is data and how we enable that to best enable the capabilities we want. And so thrilled to be here and talk about those experiences.
Well, Jake, we are also likewise thrilled to have you here. Again, looking forward to the insights. My name is Steve Soder. I'm a vice president and industry principal at Workiva. My background is a very traditional public accounting background. I started my career actually as a busy season intern at PwC, later got into financial reporting and SEC reporting, and I guess towards the end of my time in practice served as a controller at a couple of different places. And now my role at Workiva is to help, among other things, facilitate conversations just like this. So with that, let's get into the meat of it. So Workiva commissioned a global survey, just under 1,500 finance, risk, sustainability, legal, and operations professionals, plus just over 300 institutional investors. This is a survey that we run every year. And what we want to do in our session today is really talk through some of the highlights. You can see them over on the left here on the slide. A lot of what we're going to get to, the themes today, are going to be about fragmented data, demands for quality, certainly thinking about how peers are addressing the problem. We'll talk a little bit about sustainability. We have some surveys, insights from PwC, and there's actually a couple of other things that we're going to get to. So with that, again, no shortage. To me, the takeaway here is that business leaders are now treating data automation and governance as important investments to really bridge the gap between fragmented internal systems and the high-frequency, high-quality transparency that are demanded by 94% of institutional investors. Again, that's a stat that you can see there on the slides. Before we dive in, though, because I'm certain many of you are looking for CPE, let's get to our first CPE question. What is contributing the most to a lack of clarity for your business or your organization in 2026? Is it inflation, taxes and tariffs, supply chain disruptions, regulatory changes, geopolitical instability, changes in consumer behavior? Boy, the list goes on and on, right? Environmental events, competition, misinformation, or disinformation. So I would encourage you to respond to that and are looking forward to those answers. Okay, well, let's dig right in. 83% of respondents to the survey agree that geopolitical instability has led to an increase in technology investments. And Nadia, I want to start with you. You know, geopolitics used to be, let's call it maybe a higher level of macro concern for the board, but this stat actually shows that it's now become, you know, we could call it a line item in the IT budget. So Nadia, tell us, what's behind this change?
Yeah, and I doubt that it actually is a line item in the IT budget per se, but I think the headline really is that in the context of external disruption, the need and the ability to react and analyze data at speed and scale to really run your business and react to a volatile environment has hit everybody, right? So companies realize that they do not only need deep insights into their operations, into their supply chains, and a clear understanding of profitability and flows and outputs, but also what is impacting all of this, the ability to model in order to react to really certain external disruptions, right? And that then does very quickly become a question of data and quality of data. And those data that businesses need, that the C-suite needs to react to disruption, they need to be really of the utmost quality, because otherwise you take wrong decisions, right? So companies need to be able to react very quickly. They need to have the data at their fingertips, at the right granularity, at speed. And that all is a question of really, do I have everything automated as much as I possibly can? And is my IT, the enabler for this automation, really up to speed, right? So this is what drives this statistic, not to leave out, obviously, particularly in geopolitical instability, there might be trust issues with what was formerly a partner. So maybe cybersecurity plays a role in here as well.
Yeah, it's so interesting to think about the way that this has shifted, and taking those insights, Nadia, Jake, let's bring you in here. If companies are investing to solve the problems and the challenges and the issues created by this current environment, as Nadia just highlighted, how can they ensure that it's actually solving the structural needs rather than reactively, sort of responding to the latest change, such as a change in tariffs. I mean, we just got some new news on that not too long ago. Tell us a little bit about how do you ensure you actually solve the long-term problem here?
Absolutely. And it's such a great question. And look, the temptation, and it's a real one, is to fund a point solution every time a new disruption hits, right? Tariff modeling tools today, sanctions screening tomorrow, something else next quarter. But what that creates over time is a patchwork of disconnected tools that don't necessarily talk to each other and aren't flexible enough to deal with the changes affecting all of them. So the organizations that are getting it right are thinking a little differently about it, in that what they are doing is investing in that foundational architecture, right? And you heard Nadia talk about that a bit. Unified data models, flexible taxonomies, integration layers that will be able to absorb new variables, whether it's the tariff change, the new regulation, supply chain shock, and you don't have to rebuild from scratch every time to do so. I like to think about it as investing in the plumbing, not just the fixtures. And when you have clean, connected, governed data at the core, you can stand up a new analytical use case or need in weeks rather than months. So the companies that are going to struggle are the ones sitting on a dozen disconnected dashboards, each one built in reaction to the last 12 crises.
Yeah, that is so consistent with what we're seeing in the conversations that we're having out in the market. And speaking of things out in the market and conversations, we wanted to bring in a survey stat here from PwC, actually, that really addresses the value that's being created from AI. Really, really interesting. Would encourage our audience to take particular note here. And Nadia, with this on the screen, let me bring you back in. Obviously, you've asked CEOs about the value that they already create with AI, and you've also surveyed investors about their data and policies around AI. Could you maybe give us a few highlights on this and share your reactions?
Yeah, it's quite interesting, Steve. Only 30% of CEOs are seeing increased revenues from AI. And I don't know, because it's anonymous, obviously, as a survey, but I suspect that this is really around technology companies mostly, but also with some applications in industrial products and across the board, but only 30%, right? And around a quarter of CEOs see a reduction in cost, right? 56% of CEOs see neither, right? They don't see a benefit in terms of increased revenues or in reduced costs. And that is, I think, quite alarming in terms of an expectation gap that seems to be brewing. Because if you look at our investor survey and compare the high expectations that investors have towards companies to actually increase revenue and reduce cost or increase efficiency, there is a bit of an expectation gap, which is to be bridged then, obviously, by appropriate disclosures, right? And that is why investors also say that companies do not really disclose enough around AI-related investments and governance and decision-making processes. Only 37% of investors say that there is enough disclosure around this, right? There are some other 40% that really want more disclosure around the investment, the return on investment on AI. So all of that points to there's a lot of talk around AI and how it will help companies, but it's not just really made real for companies and investors, right? And that is, I think, what we will be unpicking a bit more in the course of today. If you pair that, and let me steer it slightly away from financial reporting, if you compare that with another statistic from our investor survey, percent of investors, and that is a large number, right, do say that they will increase their investment in companies that use sustainability data to improve efficiency and performance. But we also throw into the mix all the difficulties that we have discussed in the past around getting those data, make sure that those data are of high quality. You see a bit of a conundrum of everybody wants data, everybody wants granular data of high quality, but how do you get it? You need data for AI, but you can also use data, or you can use AI to get to some data more easily and more with higher quality, particularly as it pertains to data outside your very own system, which often relates to sustainability data.
It's so fascinating. Again, the conundrum that you bring up here, and I think the insights there about, okay, well, what do you do as an executive to try to solve of course, the disclosure and the communication issue that's going along here? Because clearly there's a little bit of disconnect. But then what am I actually doing inside my organization in order to drive the value that eventually I'm going to have because I'm going to be held to account if I do not? It's just fascinating, those conversations that must be happening there. We did have an audience question here, Nadia, that I want to ask, but first let me just kick off our next poll question. So what best describes the current state of cross-departmental data within your organization? Would you consider it optimized, as in you have a single source of truth with automated real-time insights, or is it fragmented? Maybe departments are often reporting conflicting figures for perhaps the same KPIs, or would you say this is completely siloed? We struggle to access data in time for critical decision making. Again, you'll need to respond to 3 of the 4 CPE questions. While the audience is responding to that question, Nadia, let's go back to this question. And I'm paraphrasing here a little bit, but if clean data is needed to succeed at AI, but then some CEOs might not be seeing a clear return yet on AI, how do we articulate the need to address data clarity for the sake of AI? It's a little bit circular. Hopefully I did an okay job describing that question.
Yeah, totally circular. And Jay can hopefully add a little bit of color to the actual on-the-ground discussions, right? But it is really around explaining very well that AI thrives on making connections between data, and it's therefore needs to be well connected throughout the company and the efforts around driving insights from AI. And it's the very old problem, right? It's garbage in, garbage out. If the data are not clean and clear, AI has so much more problems on coming up with the proper insights and answers than with clear and structured and well explained data, that the investment in data will really enable the outcome of any investment into AI. And I can only report, I've seen it myself when we tried to analyze CSRD reports of the first wave, and we used large language models and prompting and all of that. The models didn't know what to do with it because we didn't have a taxonomy and there was no tagging and all of that. It was really, really hard and still required a lot of human effort. So the investment wasn't really quite clear, but now I'm personally very clear on the need for tagging, for example. So just one example.
Well, Nadia, I'm smiling because we had a very similar response when we were going through this first wave reports as well. Like, wouldn't this be such a great use case for AI? And then you start to see the responses, and at first it like, okay, hey, this could be great. And then you dig in a little bit and, it starts to fall apart. So now we're like, all right, you read a dozen reports, you read a dozen reports, you read a dozen reports. Anyway, no, I love that. Yeah, Jake, if as Nadia pointed out, you might have some insights here. Would love to bring you in to answer this question as well.
Yeah, and I think you'll hear in some of my response here, you'll hear some themes that I'll probably come back to. But I think Nadia said, well, there's a bit of an idea, I think, of when we first started down the AI journey with a lot of organizations, there was a question of how much of bad data could I potentially still get value out of with this technology? And to be clear, I still think we have made leaps compared to probably prior technologies in what we're capable of doing and how much we're able to navigate and how much context we can add in from language considerations and documents. But I think we've learned there is still a data element that enables a greater level of value, if not the critical level of value from using this. And if anything, that's the learning journey we've gone on. So when I see the, hey, maybe I haven't delivered yet, I think this is part of the reason why. And now we're at this sort of moment of realizing that's what's needed. And so now is the time to do it. What you'll hear me talk about, and I'll go in more in other questions, is that doesn't mean it's a 3-year data journey before I'm able to start leveraging or getting value out of AI, right? It steps in the journey, and we'll talk about that. But I do think there's something there of, this is a bit of the learning I think we went through to come to this conclusion of it is critical to be enabling this to get the success from this technology.
Well, Jake, let's stick with you, and actually let's stick with this data concept. So another stat to point out here: over half of leaders say that data problems limit their impact, specifically citing a lack of real-time data or citing issues caused by siloed data. So here we see, Jake, a nearly even split between speed issues, which would be that real-time data stat, and access issues, referring to silos. So, Jake, in your experience, which of these is the more expensive or difficult problem for a company to solve, for a company's bottom line?
They are both problems, to be clear. I think we see more often the silos piece really driving more, because a lack of real-time data, it slows you down, right? And that's a speed to insight issue. Maybe it's some decision, factors with your customer or your vendor, and it's frustrating, but it really is manageable. When you talk about siloed data, now you're leading to bad decisions, independent decisions made across different departments. So when finance, ops, sustainability, you're working off different versions of the same number, different versions of the truth, you end up with conflicting forecasts, duplicated effort, misallocated capital. And there's this other cost of siloed data we like to call almost the reconciliation tax. And that's all the hours teams spend every cycle just trying to agree on what the number actually is, what drove that, what have you, before we can even begin to then make decisions off of it. And it's not really value-added work. It's waste almost being baked into the process. So real-time data, for sure, it's the next level. It's what we should be striving for. It will allow for that much more to happen, but it almost feels like that's what should come after the siloed piece. If your underlying data is siloed and then you get it to real time, you're just going to be getting the wrong answer faster, and that doesn't help anyone.
Well, thank you for that, and I'm delighted that we were able to take a convincing, determinative decision here. Usually we say, well, it depends, but no, Jake, that was great. Nadia, let's bring you back in here, because to me, there's almost like a cultural element to this as well. Data silos often, at least in my experience in practice, feel more about departmental territory than maybe unresolvable technical barriers. So, Nadia, what's the key to resolving this? Like, what leaders do you need at the table, and how can they shift the culture from, hey, I'm going to own my department's data, to maybe thinking about this more holistically as, hey, we are all stewards of enterprise data that's going to lead to the right decisions?
Steve, I think it's actually part of a lot of shifts that we are currently going through. And when I say we, I speak about us in this call. I speak about companies, the C-suite, and everybody else around, right? Where you come from a world with ERPs and a very old thinking that there is some data security if it's for eyes only, but only access needs to be restricted so that things do not go wrong, and it's only for those people that really need it. And you now come into this, as we just established, you need agile data, real time, more granular data. That shift needs to come with a shift in the governance of companies often, right? And as we said before, real insights, AI empowered, are driven by connecting various sources of information more quickly than we used to before. So it really needs a new governance, new leadership, and a new type of goals around AI and the use of AI if I want to overcome the siloed data issue and problem and really drive the benefits from connecting insights and decisions using AI or other means. It doesn't necessarily need to be AI, but AI really illustrates it so much better than other examples could.
Well, and I think to get back to those benefits that you just mentioned, and we connect that back to the survey stat that you showed earlier, those are benefits that the C-suite is aggressively looking for in order to demonstrate that ultimately to investors who have the same expectations.
And
Jake,
if I may add, Steve,
yeah.
What I'm really saying, it's up to the CEO to make that really clear to his C-suite. And then it's up to the chief operating officer, the commercial people, to collaborate with finance, to collaborate with risk, to collaborate with sustainability, to really make this happen and be really clear on what do they want and how will they get this, and then execute on it and drive it through the company. I don't really see any other way. Whilst AI often is sort of a citizen-led and bottom-up exercise, to really get the real business benefits requires this deliberate will to collaborate and break down the silos. Otherwise, it won't work.
Well, I think you are spot on. And Jake, let's maybe see if you could bring in, an insight here. What might be one collaborative, quick win, or one like relatively easy action item that could be taken with another department to maybe start to open those data pipelines, perhaps due to a mandate from a CEO or otherwise, without waiting for like a full tech overhaul? Because obviously there's probably not a lot of time for that, at least maybe in the short term anyway. Any insights on just like one thing that could be done there, Jake?
Absolutely, and this is a good conversation we have with a lot of clients. Let's start small. Let's start with a shared KPI. Pick one metric, perhaps, that both departments care about. Let's give an example. Let's say revenue by product line, something that maybe both finance and commercial report on, and agree on 3 things within that. Let's talk about a single definition of what that metric is, a single source, and a single workflow to produce it. You don't need an enterprise-wide data transformation to do that. And you might even emphasize, Steve, an area is maybe a bit cleaner already to start, right? To just start to get momentum instead of always solving the most complicated problem first. So you don't need that enterprise-wide data transformation, and it creates a proof point. Once 2 teams can demonstrate that this workflow eliminated the monthly reconciliation headache, that we were able to work together, it builds momentum internally. Leadership and others start to see the value, and some of those walls that may have been up or some of those difficulties that may have existed start to come down, right? And it also does something else that's really important, which is it surfaces the real barriers. By starting in the small area, and all of a sudden we find out, hey, was it really a technical barrier? Is it actually a definitional barrier? We think revenue by product line means 2 different things. Or is it political? We both want to own this KPI. Right? And that'll then give leadership the evidence needed to invest further. So there are, of course, things on a pure data and activity itself, but the quick one isn't even necessarily about that. It's building the muscle of cross-functional collaboration, and that muscle and the trust built in building that muscle is what scales.
Jake, I love that. And political departments never get political about owning the ever. I'm sure that never happens.
Not at all.
We actually had an audience question come in, and this might be like a tiny bit duplicative, but I think it's a great time to answer this. So the question is, again, paraphrasing, what's a practical near-term step to begin building the plumbing, which maybe might speak to some of more of the long-term stuff, but what's something that could be done to begin work on that now in order to help the fragmented data, obviously keeping in mind the terrific insight you shared just a moment ago that could be done a little bit easier?
Totally. And I think if anybody walks away from this webcast with 2 thoughts, at least from my end, I think it's 2 concepts, right? First, when it comes to all of this, it's not all or nothing, right? In any of these scenarios, the biggest mistake we see is these organizations waiting for the perfect transformation before they take an action. And you don't do that, right? It's going to take too long, and there's value to be achieved along the way. The other side, which ties into the answer here, is, taking this idea of a right to left approach. Instead of saying there's a technological capability, what can I do? Take what is the goal or the outcome I'm trying to drive, right? What is the intended output here? And is that greater insight? Is it speed? Is it better decision-making? Is it cost? Whatever that may be, right? So pick that outcome and work backwards from there. So in this case, coming back to it, right? you pick that KPI, right, that you're constantly reconciling. And the goal is to reduce that reconciliation time and make better decisions. And again, when you do that, you start to uncover the real plumbing work that needs to happen. Things like, do these two departments even define the metric the same way? Is the data coming in from different systems and in different formats? Can anyone actually trace where that number originated? Is there a clear owner? These types of, that's what we talk about as some of the plumbing, right? Standardizing definitions, normalizing formats, deduplicating records, validating accuracy, mapping lineage. Those are the actions to take, right? And so earlier I talked about aligning two departments around a shared KPI, right? Single definition, single source, single workflow. That's the work in action. It's not glamorous, but it is the work that compounds. So pick one outcome, work backwards, do that plumbing work to connect it, govern it, automate it, and then expand from there, keeping the analogy going one connected pipe at a time.
Well, Jake, I love that. Thank you. Hopefully that is helpful, not just for the individual who asked the question, but I think for our audience as well. Yeah. So let's move on to this stat. And I got to tell you, this of all the stats that we shared here, to me, this one was the most surprising, just because of how decisive that it is. 95% of institutional investors agree that business leaders underestimate the risk fragmented data causes in financial reporting. Jake, this is a big deal. I mean, a 95% consensus among investors is massive. And I would expect if you were to ask that same question to executives, how do you feel about the risk of fragmented data, that it'd probably be a little bit lower than 95%. Again, that's just speculation. But to me, I think that makes sense. I think that's sort of like a sound conclusion here. If that's the case, why would there be such a big disconnect between maybe how executives think about what the risks are versus investors who are saying, hey, nearly universally, like we don't think you guys are getting it. We think you're underestimating the risk.
Yeah, it's a good question. It's absolutely an interesting finding, and I think there's layers to it. One attempt at an explanation is perhaps perspective, right? So investors are seeing the output, the financial statements, the disclosures, the earnings calls, and they can kind of tell when the numbers don't quite hang together or when a restatement perhaps signals that something was stitched together at the last minute. They're pattern matching because they're looking at it across so many different companies and have seen before and potentially seen the risks of those mistakes before. So fragmentation may stand out more. Perhaps your executive is more in the process, right? Or actually a part of the team. So they see that the teams are working hard. They're getting the internal updates, right? And sometimes maybe it leads to an underestimation of that fragility, right? We got it done, and so it's done. So perhaps it's not as fragile, right? And so the system might work versus perhaps investors are seeing the patterns across some other companies. And also perhaps there's investors aren't just evaluating whether you filed on time, right? For them, the time is not the component. It's, does your data make sense? Are you making the right capital allocation decision? So a bit of this gap of we got it done we as achieving the goal versus the value then of that data output, right? And whether the right decisions can be made, perhaps is where some of that disconnect lives. And it's the kind of risk that sometimes doesn't show up on anyone's radar until something breaks. So perhaps investors have seen it break before, and so are aware some of that risk can be identified.
Yeah, we got the filing done, so the system works from an executive resonates with me. In my experience, works of art, much like financial disclosures, don't seem to be done. They're just sort of abandoned. You just kind of run out of time and kind of cross your fingers. I realize that's not ideal, but it maybe speaks to some of the challenges we've been talking about. Nadia, this stat here specifically calls out financial reporting, but we know that investors are increasingly looking for investor-grade data beyond financial reporting, particularly for sustainability. You have spoken a lot on this topic. Tell us, how does this play into this sentiment that we're seeing here with investors?
Yeah, I think we often say that investors want more transparency. I'm not sure that that is right. I think investors want better transparency, right? They don't want necessarily more pages. And part of that is about the connectivity between sustainability data on the one hand side and financial data, right? So, for example, the articulation of the quantitative effects of, let's say, physical climate risk, just to pick an example, right? If I speak a lot about the exercise that I've done on my physical climate risk and that I've identified this, that, and the other, but I'm not able to articulate its potential future financial effects or even quantify it, then is that fragmented data as well in the statistic, right? So it brings me back to something that I've actually heard relatively early on in this whole sustainability discussion a couple of years ago, where an investor actually said to me, look, financial reporting is like an X-ray, right? Then if I look at the MD&A, it's a little bit like a selfie, right? So how does management make sense of the numbers in the best light under the given rules, of course, right? And then you add sustainability data, and that's more like an MRI, right? Which gives a completely different perspective on the same company that I'm looking at, but only if I add it all up, if I stack it up, do I get a complete and wholesome picture of that company. Now, let's come back to something that we discussed earlier, AI. I challenge the audience to really understand, have you tried using AI to read out your company's reporting, not only the financial reporting, but other communications, a possible sustainability report, and identify breaks in the logic where things don't make sense, where things don't really hang together? Investors, institutional investors are doing this, and they're calling it out, and they're asking companies about the breaks in the logic and where data really don't fit to each other. So that's another area of fragmented data that I just wanted to highlight, not only within one statement, be that the sustainability statement or the financial reporting statement, but also between various sources of information.
Well, X-rays, selfies, and MRIs, I love the examples and highlighting the point that investors are using that. I would argue, I suppose we probably have a stat somewhere between PwC or Workiva, but I would argue that AI is probably doing the majority of the consumption now of these disclosures, and it is looking at the consistencies across the selfies, X-rays, and MRIs, or again the totality of the disclosures. Given that's the case, Nadia, from an investor's perspective, then, and you talked about this a little bit, but maybe go into a little more detail, what are some of the red flags that then signal that a company's underlying data is fragmented or unreliable? And maybe what are some early steps companies can do to fix that?
Yeah, so number one red flags, I just mentioned the number one red flag, which is the lack of connectivity between the financial reporting and the sustainability reporting, right? For example, the articulation of financial effects of certain sustainability topics that are being mentioned by a company, right, as being material. Then Jake mentioned other areas, restatements and revisions to financial statements or sustainability statements, definitely red flags, right? And then everything that we traditionally know of, shifting KPIs, selective granularity, right? I only talk about the things in much detail that I know or like, and don't talk about the other things. In my old role, I used to say ABAPs, earnings before all the bad stuff, right? So leaving certain things out and putting other things into, sorry, into a better light. Things of that nature, right? Guidance gymnastics, earnings gymnastics, right? I shift guidance depending, and that sits in sustainability reporting as well, because I do, under certain rules, need to talk about my targets and then how I will be achieving those targets. And if I then have the target shift, well, that's a little bit of what I would call guidance gymnastics, right? And how do I fix this? Well, I hate to say it, but it's all, again, about governance and internal controls around this, right? And the ability to not look at, you guys do sustainability, I do financial reporting, we don't talk to each other, we don't have anybody really looking at how it all ties together. And does that really reflect at a higher level of looking at it what my company is about and what the last year has been about? And does that really reflect what I will be doing in the future, right? And we talked about more frequent reporting as well. it's all about, again, these controls and this governance of making sure that it's not looked at in a siloed way, as we used the silos as the source of quite a bit of evil before already. So.
Well, I'm not sure if the audience could see or not, but when you use that acronym, earnings for all the bad stuff, I nearly spilled my water. I was taking a drink anyway. I absolutely love it. Let's kick off our third poll question. Which best describes the traceability of your organization's data? Would you say you are transparent, opaque, or blind? We hope that you're transparent. I wonder if there might be some opaqueness, but hopefully there's no blindness. Again, you'll need to respond to 3 of the 4 questions in order to receive your CPE credit. And let's move on now to the next stat. So, Jake, we'll ask you this question. As we can see, the top 2 projects called out here are automating data collection and validation, and the second is strengthening data governance across teams. So automation provides speed, while governance provides control. You know, out in the market, I hear a little more talk about pursuing automation versus governance, and maybe that's just a nature of who I'm talking to, but could you maybe take us through the thought process here, and what are the potential downsides of prioritizing automation, let's say, over governance?
Yeah, it's a great question. Before I answer, I want to just talk about something Nadia said that I think permeates across everything here, and then I will come back to the question. She made a comment on, I don't know if companies or investors are looking for more transparency, but better. I think that as a representation of the decision-making process with AI in particular, of we now have the capacity to create more everywhere, more content, more data, more information, but that doesn't always equal better. I think there are places and times where it's great to create more and you get value out of the fact that you can create more, but that idea of how do I shift more to better is I do think a really interesting topic throughout, transparency being in one area. I just loved that comment. And again, if I'm a listener, I would be thinking about that of it, you know, it's easier to just pump out more and more now with these capabilities, but is that actually creating better, or is that just creating more noise that isn't helpful? With that, and maybe there's a tie in here, I probably haven't perfectly nailed it. I just really liked that comment, but coming back to it, and look, this is something we've seen as we've gone and helped organizations with it, that when you automate without governing, it's the fastest way to scale a bad process, right? And create more difficulty for you down the road, right? If your data definitions are inconsistent or your controls are manual, ownership is unclear, all automation will do, and to bring back down, you know, garbage in, garbage out, it will move garbage through the pipelines more efficiently. But what's worse, it will create a false sense of confidence. Leadership or whomever sees a sleek dashboard updating in real time, and now we assume the data must be reliable, or we see potential time savings or things automated. But in reality, if no one's validated the inputs or the logic, or there's not the proper understanding of the human in the loop, over time that's going to deteriorate and create more distrust and more work than before. So governance needs to be the foundation, or at least a co-foundation in tandem, right? It's what establishes who owns that data, what the definitions are, what the controls look like, and what that escalation path is when something breaks. So once you have that in place, or as you have that in place, automation becomes more powerful and more possible, and it's accelerating a process you already trust. So the organizations in this survey that are prioritizing both are the ones that are understanding the sequencing and the priorities. You govern first and then you automate, or you govern as you automate, particularly not the other way around.
Well, and let's bring Nadia in here, because Jake, I love the thoughts, and I wonder if we could build on that a little bit. Nadia, when I saw these 2 stats, it made me think of, you know, maybe this is indicative of how companies are thinking about their AI strategy. Talked about that a little while ago. Can an organization optimize AI without these 2 pillars? I mean, does this tend to be like, hey, if you don't get these 2 things right, you can't expect to bring any benefits from the adoption of AI. But any thoughts on how these might translate to that process of AI adoption?
Look, it's almost a leading question, right? Of course not. So obviously you need both pillars. And I love what Jake said around the trust that needs to be in the process, right? And the trust is often, when you hear PwC talk about trust, you get to trust, assurance, stakeholder trust, external audits, and all of this. Well, this is not the trust that I'm necessarily talking about. This is also the trust that I'm talking about, but I'm also talking about performance trust. And that is, again, when we go back to the beginning of the conversation, the trust that management needs to have in the data that they get for that decision making. And very fast and automated, but the wrong decisions will be made. So it has to go hand in hand. How do you get good data? Well, quality as expressed through ownership, controls, governance over the data, possibly assurance to some extent. And then on top, you set the automation that then enables these data to be used in a granular level, at a granular level, fast enough for the decisions that need to be made on recent events and where the company needs to react rather quickly, or in a very broad sense where it's complicated scenario analysis and all of this. So I want to bring it back to trust, and trust always starts with governance and quality, and then the ability to react quickly.
Well, thank you for that. And thank you. Yes, that was indeed a leading question, and I appreciate you for cooperating. Thank you. We've got 2 stats and a poll question before we wrap up here. Let's get to the next stat here. So while some are pulling back, nearly half of companies are communicating more openly about their sustainability efforts, with most holding steady on their actual initiatives. Nadia, no surprise, we have seen some jurisdictions move away from sustainability reporting and try to simplify or even reduce regulation. But nearly half the survey respondents here seem to be doing kind of the opposite. What's going on?
Well, isn't that obvious after everything that we've discussed? So I'm sorry, I'm having a little bit of fun here, but really, after what we call CSRD depression based on omnibus, lots of words, right? But really the pullback in Europe, in the European Union, from very extensive sustainability reporting to something that is slimmer, affects less companies and so on. At the same time, the realization that the sustainability related data are really around how does the company create value and how is the business setting itself up for resilience towards the things that are coming towards the company, has sunk in across the globe. It's not by coincidence that a lot of countries are implementing requirements to report under the International Sustainability Reporting Standards, under the ISSB. Because there is a realization that companies need to take that different look at themselves to demonstrate, again, the ability to create value and be resilient in a very fast-moving environment. So it's quite supportive of my beliefs that companies are starting to see that, and this statistic is really starting to demonstrate or how that is sinking in with companies. And if you take sustainability out of a context of actions and requirements and regulations of behavior that some people may want to regulate, and take it back to transparency and the ability to react to what is coming at companies, it's a normal development. Goes hand in hand with the increased ability to obtain data and interpret data.
Well, and speaking of data, because I love the insights that you shared just now, and maybe for those companies that do see opportunities by communicating more openly, what's the most important thing they can do to avoid the data concerns that investors brought up earlier? Could you tie these 2 things together for us?
Be crystal clear on what is material for your company, and really make sure that you look at sustainability and operation related risks, also opportunity, in a very, very clear mindset, maybe not clouded by too much regulation, but really what is the real business issue, and then dig deeper into what that exactly means to you on a segment, country, almost location level, and what that means for you in terms of your supply chain. Where is the biggest risk in your supply chain with your suppliers? So if you take it back to what is really material to the business, you have a win-win situation, because that is what investors are really interested in. That is what will actually move, because people realize, oh, maybe we are after something that will impact the performance of the business that I'm responsible for, that I'm looking after, and you start to create agency and ownership of these issues.
Well, Nadia, I love that. Thank you, and such good insights. Excuse me. I hope our audience is listening carefully. This is this stuff is gold here. Let's get to our final reporting question. Would you like to see how multiple departments can use the Workiva platform for data integrity and governance, addressing many of the issues that we're talking about here in our webinar? And the final survey question from a benchmark report that we want to get to, we realize this is a global webinar, but there are a lot of global discussions about potential changes to SEC reporting in the midst of a discussion about moving from quarterly to semi-annual SEC reporting. We found that 94% of institutional investors prefer companies to disclose more often, not less. I'm not sure that's a big surprise. And Jake, let's bring you back in. You know, the rationale for semi-annual SEC reporting is to reduce short-term pressure and administrative burden. But this stat says that investors may potentially reward more frequent reporting, but potentially without the traditional guardrails of, let's say, a Form 10Q. So Jake, if companies decide to continue with quarterly reporting, how do they ensure their disclosures stay investor grade and not, you know, simply a press release?
Totally. And the bar for what counts as investor grade is rising regardless of the reporting frequency discussion. So if you're staying quarterly, the expectation is probably that each disclosure is consistent, auditable, narratively coherent, not just technically compliant. Perhaps there's some wiggle if you're going more than quarterly, but those are things to consider. So in my view, it comes down to three things. First, connected data environment, right? Where financial and non-financial data can reconcile without heroic manual effort. And that's an investment worth making for many more reasons than just for investor reporting. Second, to come back to the conversation, embedded controls that are trying to validate more continuously, right? Not just in the last 2 weeks before a filing. If you can move if you can move the data up to being more continuous, you can move those controls, it removes that pressure on the last couple of weeks. And third, gets more to the people side, a disclosure management process where legal, finance, sustainability, IR, other functions are working in the same workflow rather than passing Word docs and spreadsheets back and forth in the final week, right? The companies that will thrive in a quarterly or more often environment are the ones that are treating every close or throughout as controlled, repeatable process, not just the last 2 to 3 weeks on the quarter end and turning that into a fire drill.
Well, and your point about the threshold for transparency, or what is investor grade rising, I mean, you think about new income tax disclosures, disaggregation of income statement expenses have been coming out later. Yeah, the bar is rising from transparency. So getting those three things together, being sure everybody's on the same page, absolutely critical. Jake, just one last question to ask here. Because of the geopolitical environment that we were talking about earlier, you know, reporting every 6 months, I mean, gosh, that seems like an eternity. If companies were to elect semi-annual reporting, though, how would they need to adjust to maybe maximize those 2 touch points?
It does feel further, though I'm sure orgs themselves would value only having that pressure twice a year. So, but with only 2 regulated reporting windows per year, each one would carry a lot more weight, right? And so a miss could be, you know, or semi-surprise now has 6 months of narrative to unpack rather than just 3. So the stakes go up. So you need to invest more heavily in interim investor communications, right? How do you create other forms of comms, earnings, is it calls, investor days, voluntary disclosures, right? Maybe not the full statement, but some other ways to at least still keep some level of updates. And they need to also be backed by some data and rigor, right? You can't just totally treat them as informal given those timeframes. And more importantly, you can't let governance go dormant between the reporting periods, right? Just because you're moving to semi-annual doesn't mean that only means twice a year does governance or control need to be in place, right? You still need to be, creating that throughout. So if you're going to move the less, obviously you pack maybe a bit more into those semi-annuals, right? Because it's only twice a year. You then try and create other forms of comms that keep people at least aware directionally of where you're going, with not maybe the same level of rigor, and you ensure that you're not now turning into a, quote, lazier organization that's only putting rigor in your org around twice a year.
Yeah, I've had the exact same thought, just having lived in that world for quite a while. It's hard to envision you would only do that semi-annually as opposed to, having those sort of interim steps. And then, of course, the governance and the processes, disclosure controls and procedures, SOX, all of those things, right? That doesn't go away. That's obviously something that needs to persist during the year. Well, Jake, thank you for that. We are down to the end here. We've had such terrific conversation insights from our panelists. Nadia, let's start with you. Any final thoughts you'd care to share with the audience?
Yeah, I think, look, it's really all about taking the requirements of complying with regulations and really looking at that as an opportunity and ability for managers to access the right data at the right time with the right quality. And that pertains to, again, financial reporting and sustainability reporting. I could talk about another 10 minutes about quarterly reporting versus semi-annual, as we've done that exercise in Europe, and it's working. But there is these days a greater demand for information, and that means that data that live within a company need to be mastered even more carefully with better scrutiny and a company's ability to react to these data and then potentially be transparent about what these data then tell you about how the company is doing. And that really is a key component of a company's resilience fabric and the ability to create value.
Well, thank you for that. Excellent points there. Jake, we'll give you the final word.
Yeah, appreciate that. And first, just want to say thank you first to Steve, you and the Workiva team, and to Nadia being a great partner in all this. This has been a true pleasure and a privilege. And I think if there's, from a final thought perspective, if there's one through line in everything we've discussed today, it's that data quality is no longer just a back office concern or a nice to have, right? It's a strategic asset, whether we're talking about that from geopolitical agility, AI readiness, investor confidence, reporting frequency. It always comes back to that connected, governed, trustworthy data being an enabler. But in tandem with that, it is not all or nothing. You don't need it all to be perfect to get started. Evaluate function by function or opportunity by opportunity. Identify where it's strong and where the outcomes are most urgent, right? And take that right to left approach. Start with that outcome you need, work backward to determine what's needed to get there and start driving. The organizations that treat it and go through that way, take that pragmatic approach, are going to be the ones that are going to both succeed and probably be as adaptive as possible.
Well, again, excellent insights and points. Nadia Picard and Jake Weiss from PwC, again, thank you so much. Unfortunately, we don't have time for additional questions from our audience. We do want to thank all of those who have engaged during our session today. Now, if you'd like more predictions, you can check out Workiva's full 2026 predictions infographic in the resources section, along with some other great thought leadership that you will find here in the webinar console. And with that, we want to thank our panelists, again, Nadia and Jake, and we want to thank you, again, our audience, for attending. For those who qualified for CPE credit, you may download your certificate now in the CPE certificate engagement tool or in the post-event email that you will receive later today. Again, thanks to everyone for this fantastic session. This concludes our discussion today, and we hope to see you again very soon.
Thank you.